Statement of account is an important document. It has been on the exam a couple of times recently, so you'll need to understand what it is. So let's start with how to interpret it. So the name of the business at the top, that is going to be the seller, and this is the person that issues the document, and they're going to be issuing it to a credit customer, someone who buys from them on credit. So as a business, we could be issuing this, or we could also be receiving it from a supplier. So the name of the customer or the buyer will appear underneath. Then we have a whole bunch of transactions for the current period. So looking at specifically what's going to be in the transactions, there'll be an opening balance. So it says here, TGS Clothing Supplies at the start of March owed Central Clothing Supplies $300. There will be a list of purchases. So in this case, there was an invoice on the 12th of March and an invoice on the 22nd of March. The individual invoice numbers are listed and the amounts. And there'll be all payments received. So during the month, a debtor might make payments to us, so we'll need to record that. And lastly, there'll be a closing balance. So what does the customer owe at the end of the month? That'll be the last thing that's listed in a statement of account. So it's good to have all this information in one place, because during the month with our credit customers, whether we're the actual customer or the business receiving it or issuing it, there's going to be a lot of documents. So we're going to have checks, we're going to have invoices, going to have more invoices, and we want to keep records of those, but it's also nice to have a central record of all those transactions in one place. So that can be recorded in a statement of account, and when we get it from the supplier, we can tick off that all those documents actually match up with our records. So looking at that, we're looking at reliability, which said that things must be free from error and verified with a source document.